Welcome to The Explainer. Today we are talking all about small cap stocks. You know, those smaller companies that tend to fly under the radar. So why now? Well, because after years of being totally overshadowed by the giants of the market, it looks like a huge shift could be right around the corner. I mean, it's a fair question, right? For the last few years, it's felt like all the headlines and, frankly, all the returns have come from just a handful of mega cap tech stocks, the so-called Magnificent Seven. But that kind of concentration, it can't last forever. So you have to ask yourself, what's next? All right, let's dive right in. In this explainer, we're going to start with the why, the big economic signals that are starting to flash. Then we'll get into the opportunity, and believe me, it's a big one. After that, we'll break down what a promising company actually looks like in the space, spotlight a few real-world examples, and of course, we'll wrap up by talking about the risks you absolutely have to keep in mind. So here's the crucial point. The whole economic environment that made those giant, established companies thrive, well, it's starting to change. The macro winds are shifting, and that could have some pretty major implications for who leads the market next. Think about it like this. For the last couple of years, high interest rates were like a giant brake pedal on the economy. It made borrowing money really expensive, which is especially tough on smaller companies that need that capital to grow. The big, cash-rich giants, they could handle it. But now, as we potentially move into a time of falling rates, it's like taking the foot off the brake. Financial conditions get easier, and that just fuels investment and expansion. And hey, don't just take my word for it. This quote from Kirsty Dessen just nails a key historical pattern. Time and again, we've seen market leadership rotate when interest rates hit their peak. It's almost like a changing of the guard, where the torch gets passed from the giants to the smaller, more nimble players. Okay, so the winds are changing. Now, let's talk about how this is creating a potential opportunity that a lot of investors might be totally missing. Because it's not just about the economy, it's also about what things cost. Now, this is where it gets really interesting. We are not talking about a little difference here. The valuation gap, the price difference between small companies and large ones is the widest it has been in over 15 years. That's a huge deal historically. And this chart just lays it all out plain and simple. What you're looking at is the price to earnings ratio. It's basically what you pay for $1 of a company's profit. And you can see it right there. Investors are paying way less for small cap earnings right now compared to large cap earnings. It's a stark visual of just how overlooked this part of the market has become. And here's the real kicker. You might be thinking, okay, they're cheap, but are they growing? Well, according to the analysts, small cap earnings are actually forecast to grow faster than large cap earnings in 2026. So what you have is a potential scenario of lower prices combined with higher future growth. That's a pretty powerful combination. So with all this in mind, how do you find the diamonds in the rough? What are the actual traits of small cap companies that are built to thrive, not just survive in this kind of environment? Look, this isn't about chasing speculative lottery tickets. We're focusing on quality. We're talking about companies with really strong financials. That means little to no debt, they need to be consistently making money, and importantly, generating free cash. You also want to see a company that dominates a specific niche, giving it a protective moat against competitors. And finally, they should be plugged into some kind of long-term trend, like AI, infrastructure, or reshoring. All right, enough with the theory, let's make this real. We're going to look at a few different examples from our source material that really bring these ideas to life. Now, these aren't recommendations, but they are fantastic illustrations of the principles we've just been talking about. First up, we've got Catalyst Pharmaceuticals, and their whole game is dominating a very specific corner of the biotech world that bigger players often ignore: rare diseases. Catalyst is a perfect example of that niche focus and strong balance sheet we just mentioned. I mean, look at that revenue growth. It's just phenomenal. And they did it by focusing on a market with real unmet needs. But that balance sheet, $700 million in cash with zero debt? Wow, that is what you call financial firepower. Okay, next up, let's jump over to the tech world with Navitas Semiconductor. This is a company that's right at the heart of the next generation of computer chips. Navitas is all about riding a new technology wave. Their revenue more than doubled year over year because they're pioneering a new, more efficient type of semiconductor technology called gallium nitride. It's a perfect example of how true innovation can just light a fire under a smaller company's growth. And for our last example, let's talk about something a bit more, concrete. Sterling Infrastructure is a company that's all about building America's future, literally. Sterling is a classic case of having a massive trend, a huge tailwind right at your back. They've got strong earnings growth for sure, but that massive project backlog over $2 billion is the real story. That's like having your next few years of work already lined up, giving them incredible visibility into where their revenue is coming from. Okay, now we have got to talk about the other side of the coin. It is so important to have a balanced view. The potential rewards in small caps can be high, for sure, but the risks are just as real. This is not a set it and forget it part of the market. One of the biggest risks you have to understand is something called cyclicality. Basically, the performance of many of these small companies, especially in sectors like construction or manufacturing, is tied directly to the health of the economy. If the economy slows down, their business can get hit, and get hit hard. And on top of that, you just have to be prepared for a bumpier ride. Small cap stocks are historically way more volatile. You also have to watch how they manage their money. Some need to invest a ton to grow, and that can pile on debt. And they can be much more sensitive to big swings in the prices of raw materials like steel or energy. So, to wrap this all up, the sources we've looked at suggest a really compelling shift might be happening. You've got the changing economic picture, you've got these historically wide valuation gaps, and you've got strong growth forecasts. It's a powerful argument, but the key takeaway here is clear. You have to do your homework. A focus on quality companies and a careful eye on risk are more important than ever. So the question is, are we about to see a whole new cycle of leadership in the market?